If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey, welcome back. Great to have you on today. Today we have with us Axel Ragnarsson. He is an investor in the multifamily space. He does a lot of operations in the New Hampshire area, living in Boston, investing in New Hampshire. We talk about the types of assets that he's buying, small multifamilies in the 15 to 80 unit space. That's his specialty, how he's vertically integrated with his management company. And just in general, we talk about investor mindset in a way where you can easily get sidetracked on shiny objects and chase down certain things. And so we talk about some of the mistakes that he's made, mistakes that I've made, and it's definitely helpful and beneficial if you're looking to get into this type of market or looking to invest in multifamily in general. We talk about the difference between just being a capital raiser and actually owning and operating the deals yourselves. I hope you're getting a lot out of the show. If you are getting value, please go on, rate and review. It helps us a ton. Bring on amazing guests who are bringing their knowledge and expertise to you so that you're learning on a weekly basis. All right. So without further ado, let's jump in the conversation with Axel. Here we go. All right. Hey, Axel, welcome to the show. Second time. It's awesome.
Yeah, of course. No, I appreciate the invite. Happy to be here.
Yeah. So again, why don't you just tell us, the market that you're operating in and your main focus and what you're working on these days.
Sure. So I'm in Boston, Massachusetts. I grew up in New Hampshire. Fundamentally, I start at the end and I came back up, give it a quick spark notes of the story. But our business today is very similar to what a lot of people do around the country as it relates to we go out there, we raise capital, we buy apartment buildings, right? We buy multifamily assets. We have a very narrow focus in terms of what we buy. We buy small to mid-sized deals, which I define as 15, 20 to 80 unit deals throughout New Hampshire. Occasionally, we'll expand outside of New Hampshire. But very narrow focus, kind of within an hour of Boston. And that's really what I've been doing for the last 8 years since I got into this. Back in 2016, I bought my first property, which is a small multifamily property. And my first 4 or 5 years in the business were just grinding away, finding discounted off-market deals, cold calling, sending direct mail, sending direct emails, and buying with private money lending and just refinancing into long-term debt and organically growing a portfolio with my own resources and my own cash. Did that for about 4 or 5 years, realized that I had bigger aspirations than continuing to stretch myself pretty thin with my own dough. And I wanted to buy some bigger deals, wanted to buy more deals. And it was just really hard to do that, even if I was finding great deals and using private money lending. Just managing the cash just started to become really challenging. So I started raising capital from LPs in 2021. We bought a few deals in Florida. We actually expanded at the same time. We did a few deals in Florida at that time when we started raising money. And those deals all went extremely well. We sold 3 of them. We still own 1 that we're still operating right now. At the same time, we were buying real estate in New Hampshire with LP capital and just, continuing to organically grow the business. We didn't go the road that I think a lot of folks that got into the syndication game did at that time from 2020 to 2022, where they just were trying to, they became obsessed with buying large assets, 100+ unit properties. We were very okay playing in our lane, which is going direct to seller and finding discounted off-market deals in that 20 to 80 unit range and doing a higher volume of those every year in markets we understood really, really well and where we could operate well. So in New Hampshire, we bought a couple hundred units in 2021, about slightly less than about $1.50 in 22, about a little over 123. As the market started, as interest rates started to go up, our volume started to come down. But we grew the business in a very sustainable way, and now we're in a great position relative to, I think, a lot of other folks that have been in this game and have done what we've done over the last couple of years, and well positioned to continue growing throughout the rest of this year and into the future. So that's kind of the high level spark notes, but happy to dive into any component of it.
Yeah. Solid. So on the unit mix and unit size, there are a lot of guys that went to like seminars and, they came out of the seminars wanting to buy those 150+ unit deals, bigger's better type thing. And it's always interesting when I have conversations with some of the guys and some of the masterminds that I'm in. I'm like, how'd you get started? Oh man, I bought a 6 unit. Or I bought a 20 unit, or then I slowly geared up. So it's always good to hear, I guess, actual deals getting done right, and you're the principal in the deal, you're actually operating it, you're running the thing. So the question I have around that one, I like that size as well for a couple of reasons. I'm wondering why you are still operating or why you picked that size, and what is it that you're doing. I heard you're sending out mail, you're direct to seller, all these things. And I understand why, but for a listener may not understand, if they're trying to target multifamily, breaking into the asset class, you go bigger, maybe it's controlled by brokers, that sort of thing. So why do you focus on that size of asset?
For sure. So there's a handful of reasons I'll kind of walk through, just some off the top of my head. And to take a step back, when we think about fundamentally what you can do as an investor to accelerate your returns while also mitigating your downside risk, the one most important decision you make throughout the entire investing process when you're buying a piece of real estate is determining what you pay for it. That's the most important parts of the entire process, and it's really not even close. It's the most important decision that you're making. It helps to mitigate a lot of the risk after the fact. If you buy at the right price, you can go a little bit over on your construction budget. Maybe you implement your business plan over a longer period of time. It takes you a little bit longer. You misunderwrote one of your expense line items. When you buy at the right price, everything downstream becomes easier. So that's what we care about the absolute most. And then it also helps to accelerate your returns very significantly when you're buying a property at 10, 15% below market comparatively to paying market. So understanding that is a foundational fact of real estate investing, how do we actually go out there and find those discounted deals? Well, if we work backwards, I think about competition a lot when we're investing, and I'll bring it all back. But all these folks that went out into the Sun Belt and were buying deals in Tampa and Austin and Dallas and all of these extremely competitive markets, they were competing with a high number of buyers and then more sophisticated buyers, especially those larger assets. But even in the range that I was describing. And real estate it's a business like any other, where you have competition. You're competing with other buyers, you're competing with other investors. You're all chasing a finite number of deals. So therefore, you should be mindful of who you're competing against when you're going out there and doing deals. So being in Boston, we had all of the desire in the world to go down to the Southeast, and, every Wall Street Journal article talking about how everybody's moving down there. And we were, constantly thinking about getting pulled down there. And we did a handful of deals in Florida. But even within Florida, there were tertiary markets, not those primary markets. And all of this to say, we worked back into our acquisition criteria through a function of that. We need to buy great deals. It's easier to buy great deals when we're not competing with a lot of folks. So what does that mean? What do we actually look for? So we get to New Hampshire, right? We're an hour away from Boston. We're still close enough to a major city. New Hampshire is a quality market from a fundamental standpoint, but it's still more of a tertiary market comparatively to the hottest markets of the last 3 or 4 years. And therefore, we're competing with less folks. And then we say, okay, beyond that, what segment of the market in terms of property size can we focus on to further mitigate competition? Well, that 20 to 80 unit range is kind of that messy middle where it's too big for local folks who are using their own dough, or maybe it's a couple of partners trying to buy a deal. And it's a little bit too small in terms of the deal size, which I usually describe as $10 million is usually that cutoff, at least in my opinion, for larger institutions who have a much lower cost of capital than we do, going out there and raising retail funds from just accredited investors in our network. So, all right, now we know exactly what we should look for. Again, how do we increase the likelihood that we find good deals? Now is when we start sending direct mail to these owners. We start cold calling these owners. We start sending emails to these owners. And while we're still networking with the brokers and the other service providers that might be able to refer us deals, we realize that a broker deal, again, back to competition, you're competing with the largest number of individuals because they're taking it out to all the buyers in that market. So when you're going direct to seller, you're increasing the likelihood that you are not competing with other buyers, which therefore increases the likelihood you can secure a great price. And that's what we built literally the entire business around, is just doing that and becoming extraordinarily well-versed within that product size, within that marketplace, understanding the market on a street-by-street basis, much more so than other folks that are coming in and trying to compete with us. So we know exactly what we can pay, exactly what it costs to operate. And we just want to be top of mind as it relates to getting in front of all of the sellers while also maintaining great relationships with all of the deal finders, the other investors, the brokers, et cetera, et cetera. Yeah. So that's how we backed into focusing on that sizing.
Okay. So then my question is more of a tactical one and I guess a numbers one then. If you look at, because that's the same model that we use when we're targeting like single family. We're spending a ton of money on direct mail, had the staff and everybody that was vetting all the deals, doing everything that goes into that. When you think about the cost that it takes to find a deal, like I don't know what your cost per acquisition is, but I'm sure you guys know that number. But does it make sense? Are you getting that 10 to 15% discount? Is that making up for the cost? Are you doing enough deal volume? because somebody coming in and saying, hey, I really want to get into multifamily. Should I do it on my own or should I go to the broker? Like, which path is the path of least resistance, or does it matter? So,
yeah, I mean, I'll just give you a quick example, right? I think, and I think fundamentally a lot of people have trouble conceptualizing this, right? Because one, there's a scarcity mindset component of it, afraid to spend money or time or energy, right? Maybe you're not spending money on mail, but you're spending time calling, or you're spending manual time emailing owners without any certainty of there being some level of return. And you're right, there is no certainty, right? This is you have to make some kind of leap of faith here. It's like marketing in any business.
Yep.
You just have to assume and develop a plan that increases the likelihood that you see a return. But the beauty of multifamily is that the deals are larger in size, such that doing one deal, the ROI on the time investment and then the marketing dollar spend is so drastic that you're basically paying for it forever. Like literally, that's how I think about it, right? And that's not a deep level of analysis where I'm saying, hey, we spend $4K on mail per deal that we get. Frankly, I don't care about tracking that, because like I've paid for my marketing for the next 300 years over the last 2 years. You know what I mean? We spend maybe 20, 30 grand a year on direct mail marketing. You know, we're not mailing a massive data list, right? There's only a couple thousand properties on our list. We mail typically every quarter, sometimes more often. If we're opening up a new market, I have a full-time acquisitions guy, salaried, who goes out and calls and does all of that. But for example, like we bought a deal in 2021 at literally the peak of the market. I think everybody retroactively looks at 2021 as the highest price point in the history of real estate, right? And we've come down since then. We bought a 40-unit portfolio in New Hampshire. We paid $4 million. We had to invest roughly 500 grand into that, about 12,000 a unit in cosmetic renovations. So 4 or 5 in hard costs. With transaction costs, we were at 465. Within a year, while the market was starting to come the other way and while rates were starting to tick up, that portfolio appraised for $6 million. And we just sold one of those assets for even higher than our appraised value just a year ago to continue recouping some cash. That's a deal that would have traded most likely at $4.5 million. If it was a broker deal, we paid $4 million because we were direct to seller. Like, okay, so that 500 grand in equity is just like, we're good. I'm good on direct mail until the end of time. You know what I mean? So it just requires one. It just takes one. And, you know, I like to frame it this way as well. If you spend, let's say you have 1,000 properties on your list and you send mail every quarter 4 times a year, and you spend $1 a mailer. So, you know, you're spending, whatever that is, $4 grand a year on direct mail. Okay. So let's say you do that for 10 years, you spend $40,000 on, like, do we think we're going to get a deal in that time frame? You probably will, right? And if you buy that $1 million property for $850, okay, you've 3x'd it, right, in terms of equity that you've achieved at closing. And and we do tons of those deals. I mean, we've bought over 300 units direct to seller over the last few years, going direct to seller and kind of leveraging these types of strategies and these tactics. So you just do one and it all pays for itself.
Yeah.
I mean, it's lazy analysis, but it's the reality.
No, that's fantastic. I just wanted you to outline it because it for some people that I know, like people talking to them, it's difficult to conceptualize how to break into a business or to start buying multifamily. And the simple fact is, if you're doing the work, if you're doing some marketing, doing some things, answering your phone, making phone calls, then you can buy something. So it's that, and it's just the other side of it was comparing the two, either direct mail or marketing in general for your own deals, or going direct to broker and see the difference between those two. So the other thing I want to ask you about on that asset size is, like, for management, are you guys vertically integrated? Do you guys handle all of that in-house, or do you guys outsource that? And what does that process look like?
Yeah, so we own our management company, at least in New Hampshire. You know, we
right,
still have our building in Florida, which we have third party on. But in New Hampshire, our in-house PM company, we manage our own stuff, and then we also manage third parties. So we currently own about 300 units in New Hampshire, like in terms of what we personally own.
Mhm.
But the management company manages about 600 units. So it's, you know, we have 300 units in third party management we do as well. So all in-house, we control that whole process, which is kind of important for that type of market where it's scattered site, a lot of small to mid-sized properties. There are other management companies, but they're not great, you know, and just given the fact that it's not necessarily like a large mature market like a major city is, where you have, you know, even a larger number of management companies to choose from. And if you don't like one, you can go find another one, and there's usually a best in class. So in that area, we like to think we're the best in class. Obviously, we're biased, but like we built it out knowing what we needed. And then we leveraged our platform to go and manage for other folks as well to help us continue building out our team. And it's a lot easier to run a big management company comparatively to a small one, which is why we started doing third party as well. But we control that whole part of the process.
Yeah, got you. So on the tactic side, on say a 30 unit, so like I'm buying a 24 unit. Let's just talk about a 24 unit. when you guys are looking at the management, have you guys implemented any kind of tech or any kind of systems that have helped you guys manage that size with fewer people or not on-site management?
Yeah. So from a tactics standpoint, in terms of like tactical boots on the ground management, we do leverage a lot of tech, and I'll just start freeballing and sharing a
Yeah.
lot of what we do
Fire
here.
away, man.
We've started to embrace self showings as it relates to how we actually lease units. So a lot of people are petrified of that, and there is, you can't really do it with like the D plus to C plus. You got to be careful which type of properties you implement this on. But if you have a C plus, B minus, or better type of property, we use Appfolio. It integrates with a product called Tenant Turner, which is our leasing platform, and we just enable self showings so that it's a little easier instead of sending our two leasing agents running around, driving around all day, trying to meet individual residents and prospective tenants throughout, kind of a 45-minute radius. It's a very inefficient process. So the way we've structured it is they just do their laps a couple times a week to check on our vacancies to make sure that doors are locked, that that floors are clean, that no one's tracking snow in and out type of thing. But we just give prospective residents the ability to upload front and back of your ID, a credit card. You can go and check it out at your own time, right? So we increase the volume of showings from a leasing standpoint. That's been big for us.
Yeah.
We heavily leverage VAs. We have I think we have 5 VAs in the business, tenant relationship managers on the bookkeeping side, just kind of general admins helping to manage all the paperwork behind the scenes. We use all kinds of systems automations from a process standpoint. For example, a tenant moves out, there's like 30 things that have to happen, which is crazy to even think about. You think it's a simple part of the process, but then you actually write down everything that's got to happen from offboarding and security deposit disposition to getting our maintenance guy out there to look at it, to assessing what the turnover requirements are, to this, to that. Everything that's got to happen before you get it back on the market, there's like 30, 40 steps. So we use a software called Lead Simple, which again integrates with Appfolio, which in my opinion is the best property management software. We've used all kinds of different PM softwares, both on the ownership side and then as the third party client, because I've worked with all kinds of management companies as a client. Appfolio is the best. Unless you're doing like 200 plus unit institutional assets where maybe you get into like a Yardi. But for us, Appfolio is great, integrates with everything. And so Lead Simple is a platform we use to automate a lot of that process there. And then Appfolio itself too is interesting because they have all kinds of, like, they're leading the charge from an AI implementation standpoint in the PM software world. So they're implementing all kinds of like smart maintenance. Tenant calls with a maintenance problem. My toilet is running nonstop or my sink is leaking, whatever. I got an outlet that doesn't work. Smart maintenance will suggest all kinds of initial fixes to that tenant so that they can see if they can resolve it themselves before we dispatch a tech. But they also collect surveys so that we can troubleshoot any like long-term maintenance issues, try to preserve residents. So there's all kinds of stuff we do, and I'll stop there before I ramble for too long. But those are some of the big things that come to mind.
No, that's helpful. Very helpful. So I guess let's take it back to some of the stuff that you guys have bought. So you guys own most of the stuff in New Hampshire. The deal that you have in Florida, is there a reason you guys have stopped in Florida, or would you guys go back there? And even before that, like, how did you even pick that market? I know it was exploding. I know guys that were buying stuff for 30 million, selling for 70 million in like 18 months, it was like insane. So yeah, a couple questions within a question there, but
yeah. So when we started thinking about getting outside of New England, it's like the shiny object syndrome. I'm like, oh, maybe like the Midwest, that's, it's safe. But then we have the Southeast, higher growth. But then in the Southeast, we have all these cities in Florida. But then we also have Texas. But then also Atlanta, Georgia, people are moving there. So at some point I was like, you have to drown out the noise and you just need to focus on one. And if you're in the deal sourcing and operations game, like you have to have very narrow levels of focus. It's really hard to be a generalist from a market standpoint. You're going to get burned. So for me, I was like, I have a friend, just at a time, I had a friend who lived in Tampa. So I was like, okay, I'm going to go look in Tampa, right? Great city. I really enjoy visiting there. It's a 3-hour direct flight. I could see, the long-term desire to build a portfolio out in Tampa. And then we realized that we just couldn't compete in Tampa again, because everybody was looking in Tampa, right? So it was one of those challenges. Even though it had great metrics, like we just can't compete, and we're huge on buying at below market value. Like we just are not interested in doing deals unless we can do that. So then we said, all right, well, where near Tampa can we look? So we started looking inland. We looked 45 minutes inland in a town called Lakeland, which sits right between Tampa and Orlando. About 100,000 people, smaller market, still competitive, but like we could reasonably compete there from afar. Started doing a lot of direct to seller, and we bought 44 units. One transaction, we were partners in a 42 unit deal out in Daytona Beach, which is kind of the extension of I-4 all the way out to the coast. And then we bought a 48 unit in Bartow, Florida, which is like right next to Lakeland. It's basically the bordering town. And we sold those 44 units and did extremely well. We sold them in like 14 months. We paid 60, invested 10, and we sold in a year for 125 a unit. Market helped us, but
Pretty
we
good.
also
Yeah.
sold on the downswing, which was interesting and, reflective of going direct to seller there. And then we stopped actively looking there. One, because we just got busier in New Hampshire. Like there was more opportunity in New Hampshire. Two, the insurance market just went absolutely bananas and it was impossible to underwrite anything. Like deals were simply you could not pencil deals regardless of where they were coming from. So it was just a waste of our time to continue looking there. And then three, and I think this is something that a lot of folks are realizing, all of the sexy market metrics, the population growth, the job growth, et cetera, all of those are great, but you have to look at them through the lens of what is the supply growth in that market too, from a housing standpoint. Markets like Phoenix and Austin and Dallas, it's not hard to build apartments. Very pro-development government landscape, plenty of land to build. Cost of capital was so cheap over that 2-year stretch that there were just, apartments being built everywhere all the time. So you have all these people moving there, but you also have all this supply being added to absorb that population growth. So you're not really seeing any net effective rent growth. And now over the last couple of years, in a lot of those markets, you're seeing rents go the other way, where they're flatlining or coming down, specifically in markets like Phoenix and Austin. Like rents are starting to decline.
For sure.
Versus a market like New Hampshire, where no, we don't have nearly the same rate of population growth as a lot of those markets, but we do have population growth, but we have no supply growth. So rents, and this is a crazy stat, rents in 2023 in New Hampshire increased 11%, which was like 3 to 4x the national average. And a lot of the markets that I just described that were previously thought to be the hottest markets in the country and the best place to put capital have had flatlined growth, whereas New Hampshire had double-digit rent growth. Like it's insane. It's continuing the trend of what happened during COVID. So so we were like, that's just a way better story. We feel a lot more confident in our underwriting here. It's a lot easier for us to find deals because it's in our backyard too. And we were like, at some point, it just makes sense for us to kind of focus here and to just increase the volume of what we're doing in this market. And we started our PM company around this time as well, so we could operate more efficiently. I would love to go back down to Florida, and buy more deals down there. We're just going to wait until the insurance market starts to stabilize. Until then, it's just really, really challenging to feel confident in our underwriting. So that's kind of why we put a pin in that for now.
Did you guys, when you were buying the last couple of years, you guys do any bridge deals with rate caps? Do you have any issues on that front? Were you guys able to avoid that? Like, how do you guys typically take these things down when you've got equity coming on, LPs?
Yeah, so we've never done any floating rate stuff. We're never like, what's funny is like, it never even occurred to me to do that, which I guess is kind of funny. Like there was never like so I don't even want to say that we were smart or anything like that. It never even occurred to me to go the floating rate route. And, one of the major reasons is specific to New England. There is an extraordinary abundance of local banks, regional banks, local credit unions, regional credit unions that provide financing. And it's actually not a market that the agencies love, specific to New Hampshire, because it's more tertiary. So agency terms can never compete with local bank terms. So we were always going the local bank route. And therefore we're getting, 30-year AMs and fixed rate for 5 years. And we were never getting into the adjustable world. It's interesting in that other markets, though, it's not necessarily the case where the agencies were in markets like Florida or some of the other Sunbelt markets. Agencies are much more competitive on pricing. So a lot of borrowers are just going the agency route. And then that's where you have that decision where it's like fixing a rate is more compelling here, but I'm doing a value add deal and I want to be able to get out, I want to refi, and fixing an agency loan product has incredible prepayment penalties tied to it or yield maintenance. So you basically can't do anything with that loan once you close it. And that's why I think a lot of people were pushed the bridge route. Whereas when we were doing deals, we just never really faced that because I negotiate away the prepays anyways on our fixed rate loans. So long story short, never really did that. It was never really a thought process that we had.
God, you could see into the future, man. So smart.
Should give myself more credit. Yeah.
Yeah. No, it's interesting too. I think it may have something to do. I don't know your philosophy around investing and like buy and hold seems like kind of the go. Some flips, just based on the quick conversation we've had. But when you are spending your own money and you're getting into deals, like my mentality has always been similar to yours. It's like, I mean, I'm buying it. I plan on operating this thing and knowing how it's working and what's going on. Getting a a bridge loan on at 3% that I have to be out of in 2 years, and you really only have one or two options at that point, sale or refinance. Didn't really, it wasn't something that was like top of mind.
Yeah, and I will say I did use a lot of bridge debt personally for deals I personally did, but not floating rate. You know what I mean? It was like at the time, Lima One Capital, like there's a lot of these larger national bridge lenders, with 2-year terms where you can do an extension and maybe, and this is back in 2021 in terms of where rates were like low sevens, high sixes for a rate, but it was fixed, right? And I never, there was never any floating risk there. And again, I oftentimes think it's hard to lump just multifamily into one conversation. The guys doing the 100+ unit stuff, that's way over there. Let's go put you guys aside because I'm not even playing that. I'm not even playing that game. I'm playing a totally separate game. Like I'm playing this game where we go direct to seller and we buy a $2 million property for 1.7, and I can refi in 6 months and pull all my capital out, or a large chunk. So it's almost like a totally different game there, where using bridge debt on that is a little bit less risky because we're buying with so much margin and we're investing all of this time to find those opportunities, versus the people using bridge debt or floating rate debt on fully marketed deals where they're competing with sophisticated buyers and fundamentally paying too much. So it's two very different scenarios, I think, but I think we oftentimes talk about them as one, and I don't know if it's necessarily fair to either party in that sense.
Yeah, that's true. Good clarification there. All right, so you've got a podcast. I was jumping on and listened to some of the stuff on the Multifamily Wealth podcast. So you provide a lot of good information on there. Wanted to just ask you. You have this one that I looked at. It was stop effing around and just go do the work, something like that. I was like, hell yeah,
buy a property. Yeah.
Talk about that.
Yeah.
So what caused that to come top of mind and spawn that episode specifically?
So I'm active on Instagram, as you know, right? And I'm fairly regularly posting there, and then have the podcast, and people just reach out. And the amount of people that I've just spoken to personally, or also just seen talk about their journey shared on social, it's just kind of, I'm adjacent to it over the last couple of years, who decide they wanted to get into real estate, and then they listen to the Grant Cardones of the world, they listen to the other influencers, I guess, for lack of a better term here, to describe a lot of these folks that are on Instagram talking about you need to go jump into large deals, or you need to skip the single family, you need to do bigger transactions. There's all kinds of economies of scale when you do a large multifamily deal, et cetera, et cetera, et cetera. And you have a lot of newer individuals looking to get into the game who they're either waiting to find a large deal in terms of like actively going out there and sourcing one, or they want to go and raise capital for somebody else who's doing a deal like that. I think all that stuff is so stupid. Like, I don't like any of that. I couldn't be a bigger believer in the easiest way to get started is to just get started by buying a piece of real estate. Buy something that's well within your financial means. People, I think they're, buying a duplex isn't sexy. That's not fun to put up on Instagram. You're not raising money to do that. You're probably using your own money to do that. But that's the easiest way to get going into the right direction, to start building momentum. If you're starting from zero and you're trying to find a 50-unit deal, you're just not going to do that. That doesn't happen, right? And if it does happen, you are such the exception to that it's insane. So I wouldn't bet on that. I would bet on you just going out there and finding a 2, a 3, a 5-unit deal or something like that that's achievable to purchase with your own money. And not only that, does it help you build momentum, there's way more financial upside in being the sole owner of a small property for your first couple deals versus raising $500,000 for the investor that's raising $10 million, and you get 1% of the general partnership or whatever it is. And like that, you don't make any money doing that. There's no money there. Like, you're working for minimum wage when you do stuff like that. And not only that, you're not learning anything, right? You're not on the operational side. You're not making headway. So I speak with these people all the time. They're like, yeah, I want to start raising money, or I'm looking for these types of deals. How do you recommend I speak with brokers? I want to go out and buy, a 25-unit deal or something like that. And it's like, don't do that. Like, that's just not the right road to go down, in my opinion, right? And I guess I should say this is my opinion, but I see so many people that just don't get anywhere, and they spend 12, 18 months, 2 years just waiting for that bigger deal because they think that's what they're supposed to do, when the people I know that are making the most amount of money, which I think is the objective metric here, if we want to compare people and we want to actually build out a scorecard, the people that are making the most money earlier in their career are the people that go and find discounted deals. They hustle to find good deals, and they buy that $500,000 5-unit property for $400,000, and they use 80% LTV, and then they refinance 6 months in and they pull their money out and they go do it again. that
Mhm.
has a much more meaningful impact to your balance sheet, to your net worth, to the passive net cash flow that you're receiving as an investor. Do a few of those, build out your balance sheet, learn the game, then leap into either the larger transactions where you're raising money. But if you want to go raise money with other people along the way too, by all means do that. But you should start with personal ownership of real estate, in my opinion.
Love that, man. Honestly, that's like the episode. That's like the whole, we could end there. That is, you encapsulated how I feel about it in a short order there. It's interesting because again, a lot of people in the build up, I guess it's been real estate's just been going up since what, 2009, 10, like it's just been on upswing since then. So anybody getting in could easily do it. And I think in the last couple of years, at least when I started paying attention to like the multifamily space more so than the single family world, and it's probably always been this way, but like a lot of guys will come on, like the Cardones and the other guys, and they're like, hey, buy these big deals. You can start by raising capital for my deal. It was really like a lead source for them to pull in LP equity without having to do the work. And it's deceiving in a sense. If you're listening to this and you're like, hey, I want to get into these bigger deals, it's kind of deceiving. Like if you want to be a capital raiser and you love that, and that's the business you want to be in, for sure, you can build an entire model around doing that and raising capital for other people's deals. And it takes a long time to actually start earning some money that way. I would think maybe you get a small percentage of the acquisition fee or something, but there's really no payout or no money to be made in those deals. So I think what Axel just said is huge. Yeah, if you
And I'll
own
share a couple of stats here,
100%
like
of a
that
small
really
deal.
drive this home from a numerical standpoint. Because I've done this. I've raised capital for other people's deals. When I started raising money, I did that because I didn't have the deal flow myself quite yet. Outside of these smaller deals I was doing to monetize, it doesn't make sense really to raise money for like an 8-unit deal. I mean, you can, but it's just harder from a legal doc standpoint. So long story short, I went and raised for other people, and I've seen that side of the business, and there's really not a lot of money there unless you're doing it at very large scale. So for example, to use actual numbers, because I've been in a lot of capital raising masterminds, and I know people that do this at a very high level. They raise multiple 8 figures a year. When you raise money for another operator and you're being involved on the general partnership side, you're co-GPing the deal, or you do like a fund of funds, which I'm not even going to get into that because that's a very complex structure, but you're being compensated in some capacity for raising money for another investor or partnering with another investor on the capital side. Usually it waters down to you're making 10 to 20% of the capital you raise over the lifetime of the deal, inclusive of acquisition fees and then your promote. So if you raise $1 million, if the deal goes well and hits its projections, you're probably going to make between 100 and a couple hundred grand for doing that over that hold period, right? Over that 5-year period of time. Yeah. That's nice, right? I mean, I wouldn't mind making 100, couple hundred grand, right? That seems like it makes a lot of sense. But raising capital is the hardest part of being in real estate. It's a lot easier to find great deals, which people don't get that. It's actually much harder to raise retail capital with low return expectations than it is to just go out there and find a good deal, like in terms of the effort required to do both of those, unless you come from you got the rich uncle or something like that. It takes a lot of work to raise $1 million. It's a lot easier to go buy the $500,000 property for 400 grand and make your 100 grand in equity, or to go buy the $1 million property for 8. That's a much easier road to go down. You'll do that faster. You'll do that, quicker. Not only are you going to make more money, or you might make this a similar amount of money or what have you, and you don't even really need to find a deal of that margin because we're comparing it to compensation you'd earn over the life of a deal on the capital raise side. But you're going to start to generate actual passive income. There's no passive income in being the 2%er in a big GP. Like, you're not really seeing any net from that because syndicated deals don't really produce cash flow for the GPs. I mean, again, another secret behind the scenes here. GPs make money when they hit those big refis, and when they sell, that's when they get into their promote. There's really not a lot of cash flow until you're multiple years into ownership, even in a really healthy market, where the market's starting to trend upwards, which nowadays it isn't. And most GPs are never going to see their promote in a lot of the deals they put together. So it's just, what is the easier road? What gets you started faster? Where do you actually make more money? It's usually just doing some of these smaller deals and hustling to find them. So anyways, that's a rabbit hole that I could spend some time on, but that's like some real numbers as it relates to comparing apples to apples.
For sure. No, that's solid. And I think the only caveat is live where you want to live. If you don't want to operate a deal and you don't want to actually, look at real estate, and you don't want to take a phone call or go out and because raising capital is raising capital. You are providing an offering to somebody and saying, hey, here's a financial vehicle that you can invest in. but operating the deal, I mean, they're just two different businesses in my mind.
They are. And that is a good caveat for sure. If you live in like a San Diego, like I live in Boston, right? I can't buy a rental property within 30 minutes of me. That's why I'm going up to New Hampshire, right? So for a lot of people, that's not an option. But I still do think, there is still a way to think about this where, okay, well, then maybe if you've accepted that you're going to be on the capital side, you need to accept that it's going to require a volume of capital raised. You're going to have to raise a good amount of money, multiple seven figures, in order for that to be comparative to active real estate ownership.
Yep.
And if you're going to do that, it's oftentimes helpful to find a local partner, somebody that it maybe is buying in your area, right? And maybe you can negotiate some more competitive terms with them than trying to go and do it for a larger operator or something like that.
Yeah.
And try to get, you want equity, right? You want bigger equity chunks and focus on the inefficient deals, right? Like raising money for the guy who's buying the 175 unit deal in Florida. Like, again, it all comes back to where we started the show. That's an extraordinarily competitive marketplace. You don't earn outsized returns in an efficient market. The smaller segment of the market is more inefficient, right? That's where you make more money by definition. With inefficiency comes those outsized returns. So spend some time there if you want to raise, right? So that, again, helps you get going a little bit faster. Again, this is all just my 2 cents. I'm not saying this is gospel. This is just what I've seen in the business, being on both sides of a lot of these deals. But I think that there are alternative ways to getting into it versus just waiting for those massive deals that, that GC on Instagram there told you to focus on.
Yeah, for sure. I want to ask you, I guess, on your show that you've got, you have a bunch of conversations with guests that come on. Like, what are some of the lessons that you've taken from just conversations you've had with guys and been able to apply to either your business or to your strategy?
I think something that I've learned over the years, both actively and then also what I've been told by more experienced folks on the podcast, to kind of touch on what you mentioned there, you really do need to have a narrow focus and you need to put your head down for a long period of time. The more time I spend in this game, the more time I realize, and it takes so much work to not get the shiny object syndrome. Oh, I know this guy who's making a bunch of money doing Airbnbs. I'm going to go maybe I'll go take a look at what he's doing. Maybe I should go look for Airbnbs. Or wow, self-storage, the returns on those deals. I mean, that's crazy. It's a little bit more, it's easier to find those deals in multifamily, it seems, or this market, this partner, et cetera. Like, it's so hard to drown out the noise, but I honestly think it's the most critical thing you can do, because at the end of the day, real estate's not a complicated business. It's actually an incredibly simple business. You do the sales and marketing functions required to find deals and to find money. You operate really well, which is fundamentally it's just getting up every day and just doing the same crap over and over and over and over again, and never getting bored and never letting stuff slip through the cracks. And you just do that for decades, right? I mean, I think when you boil it down, it's very simple. There's no secrets. It's just doing it, right, for a while. So I was distracted. I did the stuff where I raised for other folks, and we did go down to Florida, and we did very well in Florida, right? But that took me away from New Hampshire at a time where we could have crushed it even more in New Hampshire. But I kind of stopped looking there for a little bit because I wanted to go down to the Sun Belt, because that's where everybody was going to raise money and do deals. We started marketing to nicer single family homes in vacation towns throughout New England, because we wanted and it's just like, if I had just stopped doing all that and just executed better on the core strategy and the core focus, I think we would have just made more money and built a bigger portfolio and been a little bit farther down the road. So that's what I've learned personally. And then in terms of the guests in the podcast, the people that I feel like their advice is worth the most and who I think have the greatest level of success are people that are like, I do this and I do it here and I've done it forever and I will do this same thing forever. And I'm not interested in doing other crap. A lot of the guys like, Terrence Doyle, who's an investor out in Denver. I don't know if everyone here is going to know him. I don't know if you know him, but just somebody, he's like, I got my construction company. I got my management company. We buy value add deals in Denver and Des Moines. Right. And he's like, that's just what he does. That's what people know him as. That's what he does. He absolutely crushes it. He gets the best deal flow. He generates amazing returns because that's what he does. And he didn't think like, okay, I'm going to go to Texas because people are buying in Texas and they're doing well. A lot of the larger folks that I have around me too, that's kind of their strategy. It's we're going to go so deep here, inch wide, mile deep in this market. And when you do that, you see the best opportunities and it's a lot easier to raise money. Right. And that's me speaking as a multifamily sponsor who's trying to find deals and money. When you're associated like I am, I'm very associated with New Hampshire now. We see a lot of deals. And then when investors are looking to invest with us, like we associate you with New Hampshire. We know you know it. Like we're already halfway down the road in terms of a due diligence standpoint because we know your stuff in that market. And there's all kinds of guys in the game doing this, and I have them on the podcast, and I can tell they're scattered at different times where they're raising for a deal in this market one day, and then they're trying to do a deal in a different asset class the next day. They're kind of bouncing all over, and your actions don't compound when that happens. You're not giving time the chance to help you. Time's actually hurting you because you're just resetting every time you jump into a new market or you jump into a new asset class. So I think narrow focus and letting time, time be your asset, be your ally, and over time, just compounding as it relates to your relationships, your deal flow, your ability to raise capital, and then fundamentally your returns, right? That's why we're all in this game. So yeah, I could probably come up with 100, but that's probably the one that comes to mind the fastest.
Really good advice. When I was first starting out, when I got back, I lived in Australia, came back in like 2008, started working for an attorney. I was going to go back to law school, and he was doing real estate law. And I was like, hey man, I want to do this and do that and do this. I had all these ideas. I'm going to do everything. And he's like, just pick one thing, just do one thing and stick with it and do it really well. And so that advice stuck with me, and I just rehabbed houses for years and years and years. Brings to mind another podcast I just listened to is Brandon Turner. He interviewed Noah Kagan. I don't know if you know Noah, but he's a big YouTuber and doing things, and really good episode where they're just talking about, once you find the thing that makes you the money, like the majority of people end up just trying something new. Like that thing is making you money. It's like,
I'm guilty of it. We were crushing it in New Hampshire, doing a ton of deals. We had it figured out, and I went off to go do stuff elsewhere. And it was like, why are you doing that? I don't know if you've seen True Detective, right? Season 1, one of my favorite TV shows. But like Russ Cole in True Detective is talking about how he wants to like try painting, and Woody Harrelson's like, why don't you try it? He's like, life's barely good enough. Like life is barely long enough to get good at one thing. And if that, right? And it's just such a simple statement where it's pick the right vehicle. Multifamily is a very scalable business to be in, right? Pick the right vehicle, and you want it to be like, if I'm going to work in this specific lane, whether it's the market, whether it's the type of properties you're acquiring, whether it's, if you're in an adjacent business, whatever your business is, can I work in this and can I continue to grow for decades, right? Sometimes the answer to that question is no, and you actually need to leave what you're doing and pick something else to focus on. If you're trying to build a flooring company in your local town, well, there's going to be a ceiling on that opportunity. If you're trying to buy real estate over a larger area, well, typically that ceiling's very high and you can become very wealthy doing that, and you can create a great life for yourself. So it's like, pick the right vehicle, put your head down, and then don't get distracted. And like, you just need to let time help you. And that's how time does help you, is by not getting off the track, which I did. So I know firsthand, but yeah, exactly. I got to go listen to that podcast with Brandon and Noah there. I'm sure that's a great one. I'm obviously familiar with both of them, but
it's his latest, A Better Life. A friend of mine, or a new acquaintance from multifamily stuff here in San Antonio, he put me onto it, and I was like, okay, that's fantastic. And so big shout out to Mark for that. But yeah, hey, great advice. Look, I'm going to put all your contact info in the show notes. If you're looking to invest, or if you're raising capital up in that area for some deals, by all means, reach out to Axel. He's wealth of knowledge. Check out his podcast. It's the Multifamily Wealth Podcast as well. Solid information. Really appreciate you jumping on and sharing your info with us today.
Yeah, Randal, this has been great, man. Appreciate it. And yeah, if anybody wants to reach out, love to chat with anyone about real estate. So I guess the contact info will be in the show notes there. So don't feel like you shouldn't reach out if you want to chat about anything real estate in general, or even better, New Hampshire real estate or New England real estate.
Or Florida, or maybe Phoenix. Who knows?
Or wherever. If you want to talk about Airbnbs or storage or whatever. No, but no, I appreciate you having me. This was great.
Yeah, it's good catching up. All right. See you guys on the next episode. All right, man. I appreciate it. It was good chatting with you. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.